it's mid-year. I want to point out one last thing, and then I'll jump into questions. We manage an index, the Bianco Research Total Return Index, BTRINDX. In other words, I manage an index. We tilt the index various ways to try and position ourselves for the index. How are we positioned now? Short duration, because I've been talking about where we are with the market. We have been long mortgages for a long time and short credit. Now, it hasn't worked out as well as I thought, because I've argued that credit spreads move with the stock market, and I don't want to buy overly tight. I don't want to reach for yield in overly tight credit spreads and frothy stock market valuations. If I'm going to reach for yield, I'll reach for yield in mortgages. It hasn't worked out as well as we have. The duration numbers has worked out okay. We are neutral on our curve bet. We had been bulleted on our curve bet. And then finally, we have an out of index bet of a 5% weighting in local currency emerging market debt. That's the way we manage the index. WTBN are partners with WisdomTree. They have a tracker ETF that tracks our index. Think, that BND is iShares total bond index that tracks the Bloomberg aggregate. It's the largest bond ETF in the world. It's like about $135 billion in it. It just tracks the Bloomberg aggregate index. So WTBN just tracks us, but our index is not passive like the Bloomberg aggregate. Our index is active. It's designed to beat the index. So here we are on our returns for this year. We have outperformed the Bloomberg aggregate index. That's our goal by 39 basis points year to date through July 3rd, which is when I last updated this chart. The WisdomTree WTBN, according to Morningstar, is in the core bond category. And if you look at it on an after-tax basis in 2024, it was in the 13th percentile on an after-tax basis, meaning it outperformed of the 470 funds. It outperformed 87% of them, 19th percentile before taxes are considered. Year to date, we were in the 26th percentile, outperforming 74% of the 434 funds, 13th percentile for 1 year as well, and in the 8th percentile for 3 months, 37th percentile for the last month or so. So we've been accomplishing our goal by saying, if you want to own in fixed income, don't buy the index, buy something that's actively managed. There's WTBN, it's up 18 basis points over the BND, which would be the index option year to date. That would be on an after fee basis as well. And lastly, I'll point out this is the driving force of why we do this. These are numbers from Dow Jones, S&P Dow Jones, their SPIVA report, which is their S&P index versus aggregate. I pulled out the broad bond and stock and bond categories. These are the percentage of funds that outperform their index. So for the large cap in the last year or so, what you'll see, large cap in the last year is 35% outperformed their index, meaning 65% underperformed. So in pink are all of the categories that underperform. In green are the categories that have better than 50% outperformance, and bolded is between 40 and 60. Now, what you'll notice is that no category in equities outperforms from 1 year to 15 years on the broad indices. If you want to get some narrow basis, they will show up. On the broad bond indices, what you'll notice is there are some green and there are some bolded in here that show you that at least they're between 40 and 60, close enough to 50-50. The argument I've made is that I understand the argument that no one can beat an index. That applies for equities, but it does not necessarily apply for fixed income. In the case of fixed income, there is an argument to be made that professional management can beat the benchmark. I've used the two analogies. In equities, your biggest weightings are your stars, your all-stars. They're your NVIDIA, so just went over $4 trillion, your Mag 7 stocks. If you're not all in on NVIDIA, if you don't have a massive weighting in NVIDIA, you can't outperform. And if you pass the CFA, you look at NVIDIA and it's overvalued, and you shouldn't. It says do not have an overweighting in this stock and you underperform. But in fixed income, your biggest weightings are your problem children, your countries that borrow too much, your overlevered companies, your bad structures and mortgages. And professional managers can say, here's a problem, here's a red flag, caution there. Underweight, avoid, they run into problems, they beat their index. And that's what you see. Restated, to use a sports analogy, in equities, it's playing golf. You want to beat par. The course is the index. You want to beat par. And most golfers can't beat par. In fixed income, it's tennis. There is no objective standard. You want to beat the opponent. You want to beat the other professional manager. And that's really what you're ultimately trying to do in fixed income, which is why these Morningstar rankings, these Morningstar rankings matter in fixed income, in my opinion, more than they matter in equities. And equities is how you did relative to the passive option. In fixed income, it's how you did relative to your peer group because you're playing tennis in that group. So that's how we've been doing so far. BiancoAdvisors.com if you want to track along whenever we make changes to the index. But what you should find with the way we've positioned our fund, it is, I think, perfectly consistent with the way. I only have one idea. It's what I express in these conference calls and in our writings. So it's the manifestation of how we express it. Short duration, underweight credit, overweight mortgages. I'm reaching for investment grade yield in mortgages. I think the dollar is going to continue to fall. I didn't go through that chart. I'll mention that chart right now. It's the only chart. That was the other chart that was out of place in this handout, was the chart of the dollar index. So the orange line, or the blue line, is the dollar index. And you could see that it's been moving. In the orange line, is the 10-year yield. This shaded area right here is when it decoupled. The dollar went down, yields went sideways. But what I've argued is at a lower level in the dollar, it is recoupled, and the dollar index and the dollar is moving up and down together. Now, what I think is going to happen is if rates continue to trend higher, the dollar will start to go up, but from a lower level. That's why we took our local currency debt, that was our weak dollar play, from 10% to 5% on July 1st. And we might reduce it even further in the coming weeks or month or so as well. That we're thinking that way. We haven't made a firm decision. Because if rates are going to go up because we get a sticky inflation number and the market's worried, we've recoupled this relationship. The dollar should go up. This decoupling period only lasted, when we were talking about the end of American exceptionalism, that the dollar was falling, only lasted about a month, but it recoupled at a lower level. And the reason that the dollar kept going down is rates went down through June 30th, and now rates are starting to go back up again. Okay,